Welcome to your daily market briefing. Our job today is to cut through all that geopolitical noise and get right down to the trading signals and actionable levels that you need to be watching. So here's the game plan. We're going to start big picture with a global macro pulse. Then we'll drill down into India and what's looking like a pretty fragile recovery. After that, we'll take a close look at the US dollar, and we'll wrap it all up with a technical rundown of the major currency pairs. First up, the global backdrop. We're in this really weird spot right now where the headlines are all about rising tension and conflict. But at the same time, the economic data is coming in surprisingly strong. So let's try to make sense of it. Just last week, it felt like there was this little flicker of hope for de-escalation in the Middle East. Well, that flicker was snuffed out pretty fast. By the end of the week, the conflict had actually deepened, and it's starting to leave some very real economic scars. And yet, what's so fascinating is how the market is reacting, or maybe how it's not reacting. You see all this aggressive talk, but asset prices, they're kind of shrugging it off. It's like the market is saying, okay, we see the conflict, we get it, but we're not pricing in a total catastrophe, at least not yet. So these are really the big themes driving everything right now. You've got this deepening conflict, this dangerous three-way stalemate. You're even seeing cracks appear in the G7. And then there's this weird economic duel, rising inflation on one side and this incredibly resilient US growth on the other. But through it all, the market seems to have this one simple rule. As long as the oil is flowing, it's risk on. And this quote, I think it just nails the problem perfectly. You've got the US, Iran, and Israel, and all three are convinced they have the upper hand. When there's basically zero trust, you get a total gridlock. It's a really dangerous situation with no easy way out. And the economic pain from all this isn't being spread around equally, not at all. You can see on this timeline just how unevenly this is playing out. Parts of Asia and Africa, they're already in what we're calling phase 3, actual demand destruction. Europe's a bit behind, and for now the US remains pretty well cushioned from the worst of it. Now check out this incredible tug of war we're seeing in the data. On one side, you have these undeniable inflationary pressures building up everywhere. But on the other side, the US economy just continues to chug along with strong sales, solid sentiment, and, as we'll get to in a minute, some truly blockbuster job numbers. This brings us to a really crucial point. This week's data calendar is absolutely packed. We've got the big US inflation numbers, both CPI and the Fed's favorite, PCE. Plus, we get the minutes from the last Fed meeting. So yeah, all eyes are going to be glued to these releases to see how policymakers are trying to read these very same, very conflicting signals. Okay, let's pivot now and bring it over to the Indian markets. Last week, we saw this really dramatic recovery. But honestly, when you look under the hood, the macro backdrop is telling a much more cautious story. So get this, the Indian rupee just had its best gain since 2013, which on the surface sounds amazing, right? But here's the catch. Pretty much that entire move was because the Reserve Bank of India came in and cracked down on banks' speculative positions. So that leaves this huge question just hanging there. Is this strength actually for real? And when you look at the technicals, things get even more interesting. On the daily chart, the structure is telling you to sell into any rally. But if you zoom out to the weekly chart, it's still a buy on dips market. That tension right there makes the 92.57 level absolutely critical. You've got to keep a close eye on that one. And it wasn't just the rupee, by the way. Indian equities also staged a massive comeback. The Nifty index clawed back almost 500 points from its lows, and that move was really driven by big institutions buying up some of those beaten down IT stocks. But even with that really impressive bounce, the underlying technical structure just hasn't changed. It's still a sell on a rise kind of setup. You've really got to watch that 22,768 level. That's where we expect sellers to start showing up in force. Okay, let's zoom back out and talk about the US dollar. The dollar index, the DXY, has been a huge winner lately, and it's really a one-two punch. Fantastic economic data at home, and its status as the ultimate safe place to park your cash when things get shaky around the world. This quote just really says it all. There was so much geopolitical drama flying around, you can almost forget that we got that massive US jobs report. But trust me, the market did not forget. And here's the number that really moved the needle. 178,000 new jobs. It just absolutely blew the expectation of 65,000 out of the water. That incredible strength, plus all the tension in the Middle East, was more than enough to send the DXY punching right through that key 100 level. So now, looking at the chart, the big question is, can it hold this break? That resistance up at 100.57 has been a tough nut to crack. It's held twice now. If we get a clean break above it, that could open the door for a run to 100.89. But if it fails, you're going to want to look for support back down around 99.64. All right, let's finish things up with a rapid-fire look at the majors. Here are the key technical setups you need to have on your radar for the day ahead. Okay, for the euro, it's still a sell-on-rise story. There's this feeling that the market just hasn't fully priced in the economic hit from the war. For the pound, the structure looks like a pretty good conviction sell. It's just really vulnerable to any of these escalating tensions. And finally, for the yen, the setup is to buy on dips. But, and this is a big but, you have to watch that 160 level like a hawk. That is the magic number where the talk about central bank intervention gets incredibly loud. So, we're going to end with this thought. Right now, the market's logic seems pretty simple. Oil is flowing, US data is strong, so stay long risk assets. But the real question we're left with is this just smart pragmatism, or is it a dangerous kind of complacency that's ignoring some very real, very serious risks that are still bubbling right under the surface?